AI has already made early winners. Stocks tied to machine learning, compute infrastructure, and cloud innovations have soared. But bubbles aren't born from value. They're born from belief. Belief that growth can justify sky-high valuations. What if the AI run is more hype than foundation? What if this age of exuberance masks a fragility few want to see? In this video, we'll expose 3 concrete warning signs: valuation misalignments, flow concentration, and structural divergence that many investors are blind to. We'll also bring real data, expert predictions, and historical parallels. Because in finance, when the signs align, bubbles don't whisper, they scream. Signal 1. Valuation misalignment and the capability premium. The disconnect between hype and performance. A defining feature of bubbles is when the market prices future potential over current fundamentals. In the AI boom, many stocks carry valuations anchored not in earnings, but in the promise of what AI could do. Researchers Fong, Tao, and Lee recently introduced a capability realization rate, CRR model, quantifying how market value diverges from delivered AI capability.
To some of these deals, I know there's certain deals you can talk about, can't talk about. I want to talk in broad terms about the appetite here. For the capital that we need to provide to this particular force, this growing force, AI data centers, where it's going to come from, and where you and the team are going to fit in.
So I think it's a huge super secular opportunity. There is an enormous need for funding and equity in data center. I don't know whether the $6.7 trillion from McKinsey is remotely right, but it's very, very big, and there'll be plenty of financing deals to be done, and there'll be plenty of construction to be done, and it's true in the US, but it's true in other parts of the world. And the need also to have the infrastructure and the energy will come after that. So, we all talk about data center, but there's going to be a real rush for energy in terms of providing the right setup for all this data center. And
they show that for many AI-native firms, valuations have far outpaced actual innovation. This is more than theory. It's visible in the financial filings of many AI startups and platform players that report rapid revenue expansion but thin or negative margins. The Mag 7 and explosive behavior in AI stocks. The NASDAQ and its so-called Magnificent 7 stocks, NVIDIA, Microsoft, Meta, Alphabet, Amazon, Tesla, and Apple, have come under scrutiny for bubble-like dynamics. A recent Cowles Foundation study finds speculative behavior across these names, detecting explosive dynamics in multiple periods across 2017 to 2025.
She's a member of our 12 best, our 5 for 25. I think, and it's outperformed NVIDIA pretty handily over the last year, almost double the returns for NVIDIA on a trailing 1 year. We've always called it the poor man's NVIDIA. I think we're going to have to come up with a new name. But one of the things that we're going to be paying attention to is, of course, the AI revenues. We've seen those compound at 60+%. They've announced new partnerships. We want to hear more about that. It seems that the rest of the business, the rest of the chip business may have bottomed. We'd like to hear some information and confirmation about that. And then I just think, it's just going to be about the future guidance. And Hock Tan has demonstrated he can acquire companies, make them accretive quickly. We bought the stock when it sold off on the Computer Associates. That used to be the name of the company they acquired. Wall Street didn't like it. They turned it around, made it a very positive acquisition. So we'll be listening for that too. Are there any acquisitions they're planning to make? And I certainly hope one of them is not Intel.
Yeah.
Particularly, NVIDIA's run has been stellar. Yet some of that gain reflects anticipated AI demand more than guaranteed profits. When valuation becomes decoupled from reality, the margin for error vanishes. Signal 2. Flow imbalance and capital concentration. Capital chasing momentum. One of the most classic bubble ingredients is flow chasing. People and funds pile into a theme, not because they deeply believe in fundamentals, but because they fear missing out. In AI, we see this in surging inflows into AI ETFs, mutual funds, and thematic index products. The problem? These flows can push prices higher even if the underlying companies deliver nothing new. Prominent voices warn of this momentum-driven mania. Veteran investor Bill Smead recently said AI investing is like dogs chasing cars, momentum without direction, debt-backed AI expansion. To fund grand AI infrastructure builds, many firms are issuing debt or entering vendor financing arrangements. Citi analysts recently flagged that hyperscaler capex is rising sharply for 2026, jumping toward $490 billion. But they also caution that much of this is debt-fueled, increasing financial risk. In effect, what looks like investment may be over-leveraged speculation. If cash flows don't materialize, the debt comes due, and those elevated valuations may collapse. Signal 3. Divergences and weak structure. Internal weakness despite market strength. In healthy bull runs, gains are broad, but during bubble territory, strength concentrates in a few names. Already, we see divergences. Semiconductor indices faltering while high-flying AI names continue. That suggests the rally is propped on narrow shoulders. Economists warn such divergence is a leading indicator. When the foundation cracks, the superstructure falls. Policy, rates, and external pressure. No bubble lives in isolation. Rising interest rates, tighter liquidity, regulatory intervention, all can pop bubbles. AI valuations very much depend on borrowed optimism and low discount rates. When capital costs rise, that optimism becomes fragile. RSM's chief economist Joe Bruswell has recently warned that the AI-driven market rally is overheating. He sees a potential correction ahead. Sentiment overheat and hype fatigue. When optimism becomes uniform, dissent vanishes. That's dangerous. When everyone believes, even the skeptics feel stupid to hold back. But bubble climates always overshoot, and that's when they break. Risk matrix, when signals align. Signal combination, what it implies. Overvaluation plus flow imbalance, a fragile base. Slightest shock brings collapse. Flow imbalance plus divergence, momentum survives temporarily, but brittle. Valuation plus divergence, strong names might hold, but broader market fails. You don't need all three at max intensity to crack. When even two align, danger is high. What investors can do. When the warning signs are flashing, the goal isn't to panic. It's to act smart. Here are strategies prudent investors are using to navigate an AI-driven market with bubble risk. 1. Stress test a portfolio. Run downside scenarios. Ask, what happens if AI multiples reprice downward 20 to 30%? Model the impact on holdings heavily concentrated in AI or infrastructure plays. Look at tail risks, correlation breakdowns, and worst-case drawdowns. Don't assume linear upside. Prepare for non-linear falls. 2. Diversify away from pure narrative plays. If a stock or fund story is all potential and no profits, it's vulnerable. Balance narrative bets, AI growth names, with stable, cash-generating, low-volatility assets. Consumer staples, utilities, dividend payers, infrastructure. Hold some cash or equivalents as optionality. When bubbles pop, liquidity is your power. 3. Set guardrails and exit points. Define thresholds in advance. Valuation multiples, yield compression, earnings miss, flow reversal. Set stop losses or hedges. Put options, index hedges, so you're not caught emotionally when a break accelerates. Don't double down in weakness out of hope. Let discipline guide. 4. Focus on defensible fundamentals. Back companies with technology moats, recurring revenue models, actual cash flows, strong balance sheets. Avoid speculative pre-revenue AI startups unless you treat them as high-risk allocations, e.g. less than 1 to 2% of portfolio. Prioritize transparency, management credibility, and alignment with meaningful adoption rather than hype. 5. Watch the real signals, not the noise. Don't fixate only on headlines. Monitor valuation gaps, fund flow charts, divergence indices, margin expansion or contraction, insider activity, crypto spillovers, regulatory shifts. When multiple signals align, that's your tripwire. 6. Use hedging strategies. Use options, index hedges, volatility trades to protect against sudden downside. Pairs trades. Short one overvalued AI name, long a more stable counterpart. Consider strategies like collar hedges, tail risk hedges, or volatility skews designed to profit from disruption. 7. Stay informed, stay skeptical. Keep tabs on forward guidance, earnings quality, margin pressures, supply chain constraints, geopolitical risks, regulatory proposals. Track macro variables, interest rates, capital flows, credit squeeze, policy developments. Maintain a skeptical lens. If a narrative sounds too good, especially with future promises, it needs extra scrutiny. Conclusion. The AI bubble isn't a fanciful worry. It's a credible risk emerging from the tension between belief and delivery. We've walked through 3 warning signs: valuation misalignment, capital flow concentration, and structural divergence. We've seen how each, alone, can destabilize. When 2 or more align, that's when corrections tend to accelerate.